Essentially, there are only two types of policy forms that you can purchase in the medical malpractice field. One of them is called an occurrence-type policy, and the other is called a claims-made policy. An occurrence-type policy is very easy to understand. In an occurrence policy, it's similar to a homeowner's policy or an auto insurance policy. So long as you have insurance, when the alleged incident of negligence occurs, you will be covered by the insurance company. Very simple to understand. Well, in the 1980s, medical malpractice insurance companies introduced a new type of policy, and that was called a claims-made policy. They broke the occurrence policy into two different segments. Now, in order to be covered by the insurance carrier, you have to meet two conditions. The first condition is obviously that the incident of negligence occurred while you're with the insurance company. But number two, you also have to have the person who's suing you bring up that claim or lawsuit at the time that you still have insurance with them. Now, if a doctor wants to be insured for somebody who brings up a lawsuit after they leave coverage, they can actually get covered by the insurance carrier if they buy what's called an extended reporting period endorsement, or what we call in the industry a tail. Now, when you purchase that tail, you're essentially buying coverage for somebody who brings up a lawsuit for incidents that occurred while you were with that insurance company. That tail, however, will typically cost you 200 to 300% of your prior year's premium. Now, here's an illustration of the cost comparison of the two policy forms, the claims-made versus the occurrence type. The only primary advantage of a claims-made policy to physicians is that they save the capital in the first few years of that policy. Typically, the first year of a claims-made policy will cost approximately 40% of what an occurrence-type policy will cost. The second year, that savings is reduced typically to about 60% of what an occurrence-type policy will cost. By the third year in a claims-made policy, you could see the savings become very minimal. And by the fifth year, your policy in a claims-made policy becomes mature, and you pay the exact price that an occurrence-type policy would cost with most insurance carriers. Very often, agents and brokers that sell claims-made policies will try to attract or induce a physician to purchase a claims-made policy by telling them that they can save the capital in the first few years versus an occurrence-type policy, and they could also, and probably will, qualify for a free tail instead of paying 200 to 300% of their prior year's policy premium if they're non-renewed. Now, that leads us to this slide, which is, will a physician receive a free tail? This is probably the biggest misconception that every physician has about a claims-made policy. In order to receive a free tail, a physician must be one of three things. Number one, deceased. Number two, be completely disabled. Or number three, meet three requirements: that they be at least 55, 60, or 65 years of age, and that depends on the insurance carrier, retire from the practice and never see a patient again, and number three, be insured with a carrier for 5 consecutive years. Now, most doctors do not meet these requirements to get a free tail, contrary to what agents and brokers who sell this policy state. Now, according to one of the top 5 largest med-mal carriers in 2006, which writes claims-made policies only, they reserve less than 3% of physician policies in premiums to receive a free tail each year. The most important thing to remember here is that it's not a unilateral choice by the physician to stay with the insurance carrier. So the 5-year requirement to get a free tail may never be met. What if a physician were to actually get a claim within the first 2 years and becomes non-renewed by that insurance carrier? They certainly won't meet the 5 consecutive year requirement. Now that you understand the basic definition and an illustration of the costs regarding a claims-made policy versus an occurrence-type policy, let's test your knowledge. Let's give an example. A physician is 56 years old, practices general surgery, and would pay $20,000 a year if he joins a claims-made policy in the first year. Now, question number one. After year number 1, even if there's no rate increase during the year, what would be the expected cost going into year 2, generally in a claims-made policy? The answer is at least 50% more than the previous year, bringing his annual premium to an estimated $30,000. Question number 2. What year will his claims-made policy mature? And what is the estimated cost when that policy matures? The answer for that is in 5 years, every claims-made policy matures, and the cost should generally be the same amount as the occurrence-type policy at that time. Now, in our example, if we assume that there are no rate increases over that 5 years, that claims-made policy will cost the same as the occurrence policy, and that would be $50,000 by year 5. Question number 3. After 6 years with the insurance carrier, the physician is now 62 years old and has met the first of the 3 criteria for a free tail. The physician also had a claim and is being non-renewed during the year. Now, does that physician need to pay for a tail? Now, this is the tricky answer, and the answer is yes, because he did not retire and cease seeing patients, so he will not qualify for a free tail. The physician will be forced to pay generally 2 times what his last year's premium was, which in our hypothetical was $50,000. 2 times that amount is $100,000. More importantly, he only has 30 days to pay that $100,000 to cover the claims that are reported into the future, or his tail endorsement period. Question number 4. Can the physician simply buy a nose or prior acts coverage with another carrier when they're dropped from the claims-made policy? The answer is that he may be capable of doing so, but keep in mind all he's doing is going to another claims-made policy and needing to meet those 3 criteria for a free tail. Question number 5. If a physician is non-renewed due to a claim, will some insurers assess a higher tail endorsement at the time of their non-renewal? The answer is yes. Some carriers actually assess 50% higher penalties if you wish to purchase that tail endorsement if you have any prior claims history. Question number 6. Now, if a physician had bought a claims-made policy from Pro National Insurance Company, during the year, Pro National has a 50% rate increase. Will this 50% rate increase the tail endorsement cost if he's non-renewed at the end of the year? The answer is yes. Pro National is one of the few insurance carriers that currently believes that they can charge rate increases during the year to a physician's tail endorsement, even if they're non-renewed at the end of the year. The final question is, what is the biggest disadvantage of a claims-made policy? And that's relatively simple. In a claims-made policy, if the insurance carrier goes through a significant rate increase during the year, a physician is faced with 2 options. Number 1, paying for that rate increase at the end of the year, or number 2, leaving the insurance carrier and paying a tail, which is 200 to 300% more than whatever they paid last year, simply to leave the insurance carrier. This concludes our 2nd video education series, and the next video series is entitled, How Much Insurance Coverage Should You Buy?